The Fed isn't cutting because the economy needs it, they're cutting because Wall Street is demanding another hit of free money, and Michael Kontopoulos says that could blow up the frothiest parts of this market. Watch to the end, because Kontopoulos names the exact pocket of the market he thinks gets hit hardest if the next Fed chair doesn't play along with Wall Street's liquidity fantasy.
Committee members where I think Chair Powell is going to have to come out with his cut, but then kind of talk the market a little bit hawkish and say, listen, January is certainly not a sure thing. In fact, it likely won't happen. And, the balance of risks right now are pretty much tilting towards tighter versus market expectations rather than easier.
Yeah, so let's extrapolate a little into 2026 then, Michael. We've been talking about this for a while, but the assumption that the Fed will in fact be dovish and will deliver cuts next year because there will be a dovish chairperson put at the helm. But the fact of the matter is it's a very divided Federal Reserve right now, and we don't actually know what will happen. We don't know what will happen at the longer end. I'm just wondering, how you think about that and the possibility that the market could actually be disappointed because they might not get what they're pricing in right now at these valuations.
Yeah, I think much of the rally we've seen over the last 6 months or so, Melissa, has really been driven by liquidity and the expectation for the Federal Reserve to cut interest rates next year. And to your point, I don't think that's really sustainable. There's not a good reason to do so. If the next chairperson were to come in and cut interest rates and inflation remain around 3% or even go higher, if economic growth continues at sort of the level it is now, you're going to see meaningfully higher interest rates. And that's actually going to put a dent on some of these high valuation speculative excesses within the market. And that's not just, sort of AI. I'm talking about cryptocurrencies, credit spreads, meme stocks, SPACs. I mean, they're all liquidity driven investments off of expectations for an easier Fed. So from my perspective, this is one of the biggest risks to the broad markets at the moment, but also creates a lot of opportunity as well.